Cześć, Artur Wiśniewski z Stockbroker.pl. Witam Was serdecznie na Pasywnej Rewolucji i zapraszam na panel dyskusyjny Geopolityczna, góra, lodowa. Najpierw nakreślimy sobie kontekst. Porozmawiamy o tym, jakie są aktualne trendy na rynku ETF oraz jak zdywersyfikować portfel w 2025 roku. A następnie, mając ten kontekst oraz mając na uwadze napięcia w geopolitycznym systemie światowym, zastanowimy się, jak przygotować portfel na wypadek wojny. Weźmiemy też na tapet inwestowanie w spółki sektora obronnego, zastanawiając się, czy można je traktować jako swego rodzaju ubezpieczenie na wypadek wojny, biorąc pod uwagę, że są one aktualnie jednym z najbardziej popularnych tematów inwestycyjnych. Serdecznie Was zapraszam. Hello everybody, thank you for joining Passive Revolution Conference, and I'm happy to see you in the panel discussion about ETF trends and geopolitical iceberg. Welcome, we have three guests with us. Martijn, Rozemuller, CEO of VanEck Europe. Hello Martijn.
Hey, hi Artur, nice to be on today.
Tom Bailey, HANetf.
Hi, thanks for having me.
And Henry Jim, ETF analyst, Bloomberg Intelligence.
Hi, everybody.
Thanks for joining the conference and our discussion. Henry, I would like to start with you, actually, because you really have a broad perspective, because every day you look at ETF market. Could you show us, could you get us the perspective of the ETF market nowadays? I mean, what are now the ETF trends? Where do investors are putting their money now? What is the condition of passive revolution? I mean, how are ETFs, which are usually index funds, how are they used by investors? Where do we put our money?
Oh, where are the trends? Well, let me start with the general state of the industry. As you know, I do a weekly and monthly reports on ETFs. So indeed, I look at them every day. We're already currently at 2,300 ETFs now in Europe. Those are just unique funds. That's over 4,000, I think now, by share classes. We're at 2.3 trillion in assets, and we're on track to have a record year in flows. Last year we had 250 billion flows into ETFs. That's throughout the year. And this year we're already, year to date, we reached 230 already. So to answer your question, where is the money going to? At the beginning of the year, we saw a lot of money going into US ETFs, and that has slowly switched over to global, like Acqui and FTSE All World ETFs, and also European ETFs. And more recently, we've seen a ton of money going into precious metals and thematic ETFs such as defense. I think my fellow colleagues here on the call will concur, since some of their products actually cover these strategies. So again, we've seen 80% of the flows going to equities, and of those flows, most of it was going to the US at the beginning of the year, and now that's slowly turning over to global and European focus ETF strategies.
Thank you very much. Martijn, how does it look like from your point of view? Henry mentioned that stocks draw attention of investors, especially global strategies, but also he mentioned that among thematic ETFs, defense is one of the hottest topics. So how does it look like from your point of view?
Well, I can definitely confirm Henry's statement. I think in our case, defense obviously played a big part. Year to date, we've seen the defense product grow from around 1.6, 1.7 billion to close to 8 billion today. So yeah, there's been a lot of growth, and it's not all net new assets. There's also market movement there, of course. But I guess about half of it is actually net new inflow. So there's definitely interest there. We see other thematic ETFs that have been very popular. Nuclear, our uranium and nuclear ETF has been very popular. Obviously, SMH, semiconductor, is still a hot theme, but then also the gold miner ETFs. There's been a lot of inflows, so the increase in gold price has definitely not gone unnoticed. So people take an interest, and the gold miners have also sort of caught up with the gold price after some time of lagging. And then lastly, also the global equity market. So we have a global equity product that focuses on a sort of a high dividend strategy by Morningstar, and that is also one of our top 3 products year to date. So yeah, it's been really amazing. I actually told someone the other day, in the last 9 months, we raised more assets than in the 15 years before. So let that sink in, to paraphrase our good friend Elon Musk. It's amazing how the ETF market has been doing over the last 9 months.
Thank you very much, Martijn. Tom, how do ETF trends look like from your seat?
Yeah, I mean, it's actually a kind of similar picture to what Martin said for VanEck. We have a few overlap in terms of products. The defense theme this year has been huge. We've seen almost 2 billion in terms of net new flows into our defense products this year. We've seen strong interest in our uranium mining products as well. Kind of the same, obviously different approach, but the same theme as Martin mentioned with the nuclear products. We've seen flows into our uranium mining. And then the other big one for us this year has been gold, both in terms of just our kind of standard ETC we've had for a while, but then also increasingly what we've seen is a growing amount of interest and flows into our hedged gold products. So these are the gold ETCs, but obviously remove the dollar risk from there, and so they're hedged in euros, sterling, or Swiss francs for those investors, and that obviously reflects that kind of more and more uncertainty around the US dollar. And then as a whole, HANetf reached 9 billion in AUM just a few weeks ago, reflecting obviously very, very strong inflows this year. I think we started the year on about 3 billion in AUM. So a mixture of price and flows got us to 9 billion. So I mean, it's a record year for ETFs, as good looking up to be, as Henry mentioned. We're already very near the flows you saw into ETFs last year already, and we have a few more months of the year left. So I think it's on record for the European ETF industry to be a record year.
Thank you very much.
I would just add, Artur, that I think just generally speaking, what I'm looking at when I look at the flows, it's whereas before investors seem to be allocating the portfolios by equities or fixed income, I think we still have that in terms of the big flows going into equities or fixed income, but increasingly I'm also seeing a lot of investors, or I wouldn't know investors where the money coming from, but flows are going into core ETFs, either equities, whatever region they may be, and then they use fixed income tactically or strategically, and then increasing amount of flows are going to the thematic, or what I call solutions-based ETFs, thematics, income buffer ETFs, for example. Yeah.
Thank you very much, Henry, for this addition. Martijn, Henry mentioned that global stocks ETFs are is this the category which draws the most investors' attention and money. But for the past 12 months, I've heard so many voices that this all-world strategist does not work anymore. I mean, I've heard investors complaining that in these ETFs, a few big US stocks play too big role. I mean, these portfolios are too much concentrated. And if we look at ETFs which were issued in the past 12 months, we can see a lot of ETFs which try to limit the share of US stocks. I mean, for example, equal weight ETFs, or all world, but without USA. So how to diversify portfolio in 2025 when we see that like 30% of the global portfolio are like 10 stocks from USA? what is the right proportion of markets which provides good diversification? Martijn.
Well, it's a great question. It's actually a question that I have been asking myself since 2011, probably, when we came, well, at that time it was still Think ETFs, which was later acquired by VanEck. But at that time we were constructing our first global equity ETF, and we were actually discussing this sort of overweight to the US when it came to MSCI World or similar indices. Because of the market cap weight approach, you easily end up with 65-70% US stocks in a global basket. Now, we were at the time primarily focused on retail investors, and we were a little worried on sort of the message that a global equity product would give to people when they find out they are like 65 or 70% invested in the US. So the global diversification from that perspective is then obviously not great. So we started looking at geographical capping. And even until today, that product that I'm discussing now has been around since, I believe, 2011, off the top of my head. And that product works with a regional capping. So basically, each region is capped at 40%, which meant in reality that obviously the US was the only region that always would sort of bump into the cap. And I think at first, in all honesty, it didn't always sort of work. In the sense that the US has had many, many good years. So yeah, people tended not to mind too much to be over invested basically in the US because it worked and they were fine with it. But yeah, especially since last year, people have started to question that investment belief a little bit and have started looking at other options. And I think it's good to know for people that yes, there are other options. There's definitely some global products that have a different regional weighting, and then yeah, if you combine this with equal weight, that is definitely a good solution to not be too exposed to sort of the mega caps, because yes, if you have an MSCI World, but then the biggest 10 companies are 20 or 25% of the index, that's obviously a little bit strange, because the diversification that you think you have, you may actually not have it. You may be much more exposed to some companies than you would think. Although I also believe that investors should always look at the index or the underlyings of any ETF just to make sure they really understand what they are investing in. But to conclude, I think it's good to at least have an opinion on what region you're allocated to. And I think it's also good to be aware whether or not you are allocated to just a couple of really big stocks, or if you prefer to be in an equal weight product where the diversification is managed, at least I think, a little bit better.
Thank you very much. Tom, what do you think? How to diversify a portfolio in the times where top 10 holdings can account for like 20 or 30% of the global portfolio?
Yeah, well, I think one thing so obviously we can take the MSCI World Index, MSCI ACWI, and you can see this concentration, and there's two parts of that concentration. One is obviously geographic and one is sector-based, as you kind of alluded to. And one thing to keep in mind is obviously, that is one product. I think investors want to think about that at their portfolio level. So if they're doing a core satellite approach, then obviously if the core is your for your equity portfolio is MSCI World or ACWI or something similar, then it's obviously then the question of, in your other parts of your portfolio, are you adding to that concentration? If you just take the fact that, 70% of MSCI World is US stocks, okay. Now, is that overweight, underweight? I don't know, because that's the benchmark, right? But then considering when you're adding other elements to your portfolio, are you adding to that concentration? And therefore, you want to consider, when you say adding a thematic product, is it simply dominated by US names? To potentially what you might view as an unreasonable degree. So that's, I think, one aspect. And also, are you just getting more exposure to those tech names which are already well represented in the portfolio in the MSCI World Index already? So you want to think about portfolio levels. It's not to say the MSCI World Index is what it is, and you have that. That's a global benchmark. then how does that look in your portfolio and what else you're doing in terms of adding to that concentration? In terms of, the big concentration in a handful of names, we should probably keep in mind, though, at the same time, that, okay, you have this handful of tech names now dominating the US market and then by extension, the world market. Henry's colleagues at Bloomberg kind of made the point on this before. These are huge stocks. They've made hundreds of acquisitions over the last few years. If you were to spin YouTube out of Google/Alphabet today, it would still be the 19th biggest stock in the US. So kind of just thinking of, yes, these are a handful of names dominating, but they're huge companies with sprawling kind of portfolios of products and businesses internally. So when you think of it that way, the concentration in those names looks less concerning. And then at the same time, we consider where growth is coming from the US. So some recent data I read, if we look in the first half of the year in the US, 92% of GDP growth came from information processing equipment and software. So that's really where the growth has come from. So you don't necessarily want to, not have exposure to these names. They're huge names. They're very cash generative. They're growing fast. But obviously, you want to then consider when you're adding other stuff to your portfolio, are you simply, adding more and more on top? And that's where I think, when you're looking at thematic, having those individual stock caps come in or regional caps come in is key. So you kind of understand that, yes, by default, the market is overweight or very heavily weighted towards these names, and then understanding where you go from there in terms of maybe adding a diversifier in terms of an equal weight or a more geographically constrained product.
Thank you very much, Tom. Henry, what do you feel? Is your heart closer to market capitalization strategy, or maybe equal weights, or how do you look at this?
Well, I was actually an ETF product developer for almost 20 years, so I'm agnostic. I think it's what the clients want or what they're trying to do. But I agree with Martin and Tom. That's with Martin that investors haven't really minded what is available in the market because the U.S. market has been on a tear, so they've done well. They don't really complain. And as Tom said, these businesses are fairly diversified within themselves. However, there do seem to be some lines of anxiety growing. So we do see products coming out that address some of these investor anxieties. For example, there's been a couple of products just launched in the past couple of weeks, world mega caps. So there's a fund that invests in the whole, especially the mega caps, but then there's a fund that invests in the whole world, but X mega caps. And usually those are US stocks, for example, right? And then you also have, for those who are unsure, who still want to be exposed to the US and these tech stocks, we have the buffer ETFs. It's a big deal right now in the US where using options, they limit the downside on an S&P 500 or NASDAQ 100, for example. You give up a bit on the upside, but this is to alleviate especially the boomers or people who are closer to retirement and who have built up a pot of wealth and they want to protect their investments over time. So they find those useful, right? For Europeans, a lot of broad equity in the index ETFs have been flat year to date. So they're branching out to like currency hedge strategies. Doesn't matter what the underlying strategy is, and also the thematics that we've talked about. And lastly, also on the older end of the investor spectrum, we have income ETFs. These are strategies that use options. Sell cover calls, for example, to generate premium income, right? So these are all solutions-based strategies that complement these broader regional equity indices. And lastly, also seeing some tactical uses of fixed income ETFs. This might not necessarily be just by the end investor, but maybe more by institutional tacticians, in response to interest rate expectations or inflation expectations. Right.
Thank you very much. You helped us draw a very valuable background for our main topic, which is geopolitical iceberg. I mean, we all see these tensions globally. I mean, the competition between USA and China. One of the stages of this competition is probably Ukraine, our neighbor. I mean, because Passive Revolution Conference takes place in Poland. Ukraine is our neighbor, and we can see the war between Ukraine and Russia. It's quite it's a fact which makes Polish investors quite anxious. We are thinking if we should consider adjusting our portfolio to this situation. I mean, maybe you should invest more in stocks or more in bonds, more diversify or more concentrate. Maybe we should choose Polish broker or foreign broker. And so this is like one category of thoughts which we might have. And the second one is concerns the trend which you actually all mentioned, that among thematic ETFs, the different stocks ETFs are very, very popular. Also in Poland, which we also observe in the data. They are in the top in popularity. So can you say that defense stocks might be some kind of insurance against war, and it's a good idea to concentrate our portfolio on defense stocks if we have war behind the border? Tom, maybe we could start with you this time.
Yeah, I mean, so of course I would say broadly, yes, we just listed our defense ETF on the Warsaw Stock Exchange. But within your question, there's that distinction around, should we be using defense stocks as a hedge in this scenario? That's an interesting point, and it's there is obviously this tendency of, when you do see a geopolitical shock, defense stocks rally. So you could view them as a hedge in that sense. As to hold, but I don't think most investors are necessarily buying defense stocks as this kind of portfolio hedging tool. Instead, it's the growth story which has come around the past, obviously, 3 years since the war started, but particularly has become stronger since Trump's election, and then the various different scenarios, events we've seen this year, in particular around the US and Ukraine. So these defense stocks are ultimately people buying them, I think, principally for the growth story, in that, last year, European defense spending increased by 17% compared to the year prior. We've had this commitment now from NATO members to spend 3.5% of GDP on conventional defense by 2035. Poland is already there. It's surpassed 3.5% on conventional defense, but for the rest of Europe to catch up. And then these kind of forecasts out into the future, and you can see the strong earnings growth from these defense companies. So in terms of using as this kind of as a hedge in a riskier time, there is some element of that in terms of how these stocks behave on the back of geopolitical news, but it goes both ways. The week after Trump had his conference, it was summit with Putin in Alaska, you saw the defense stocks all over the place. You saw Renk, Rheinmetall, etc. Because obviously it was a very unclear outcome what that meant, the summit. But they're very sensitive to this news flow both ways, these stocks. But I think more broadly, investors want it for the growth aspect. In terms of that hedge against geopolitical risk, I think that explains demand for gold, particularly this year. Obviously, we've seen gold last 3 years has seen very strong performance. Again, this year, very strong performance. What you saw different this year compared to, we saw two different things this year compared to last year. The first being actually the strong performance of miners, but more importantly, in terms of how investors are behaving, last year we saw 5 billion in outflows of gold ETCs in Europe, and you saw essentially a few billion come in US gold ETCs. So no one was really, the investors using ETCs/ETFs weren't really buying gold. This year it's a complete reversal. So we've seen 10 billion in positive net new flows for gold ETCs in Europe this year. So I think that is also how investors are trying to hedge in this less certain time.
Thank you very much. Henry, what do you think? How can we prepare portfolio for the possibility of war? Can defense stocks play some kind of role in this strategy? You are muted.
I'm not sure, to be honest. I kind of agree with Tom. I mean, if all out war breaks out, we could see increased production, manufacturing, and rallying across all sectors. I think not necessarily defense, and especially concentrated defense ETFs like regional ones in Europe or in Asia. Those might provide some hedge against a war in terms of performance. But I think like Tom said, defense is a long cyclical, have long investment cycles. So we're talking about 5-10 years. Once the investment is committed to, I mean, that's more or less it. Even if a full war breaks out, the rally will be across all sectors. I think indeed I would also say precious metals like gold, maybe even silver. Silver's been rallying lately too. But when you have gold ETFs, you also have to look at where the gold is stored. For example, it could be in the Royal Mint, it could be in Switzerland, it could be in London or even New York. And also because where the war breaks out might also be a factor. And that's why if you expand a little bit and look at also gold and silver miners and producers, that might provide a slight sliver of protection against, where the gold is held. And I'm seeing that too. I think a lot of flows going into gold ETFs, the gold is rallying. But I think defense ETFs, if you're talking about pure performance, might not be an exact hedge against all-out war breaking out on global. I think if we have an all-out global war, then we have a lot of other things to worry about, right? Yeah.
Thank you very much. Martijn, if you lived in Poland, how would you prepare your portfolio in case of war? You are muted.
So I think whether I live in Poland or in any other European country, I think for my portfolio, it would probably not make too much of a difference. I would definitely want to do what I always do, and that is be very diversified. Now, are there any particular choices I can make to sort of, have an extra hedge against the war? I think it's hard. I think what was said earlier on defense stock and or defense ETFs is quite valid. There has been already a big run up because of everything that happened in the last 2 or 3 years and all the extra investments that need to take place. If an all-out war breaks out, probably defense would maybe increase a little bit more, but it's not per se going to double or triple again. I think gold or gold miners could definitely be of interest, but maybe even something like Bitcoin could be of interest in the case of war. If war would lead to, let's say, very high inflation, for instance, having Bitcoin could make sense, just like having gold. I think my current portfolio, which is always quite diversified, would probably still do okay-ish. And then there would be some changes in the portfolio, and then for me probably not until retail anyway. So I think whenever you want to act, if something already happened or is going on, then probably always too late. So it's much better to be there and have your portfolio left, right. Basically able to or take on any event. And there's never a reverse for anything.
Gentlemen, thank you very much. Thanks for sharing your opinions and you helped us broaden our perspective. So it was very helpful, and I think there is never one right way of investing. But you proved us that there are always a few options, and in the end, we all need to ask ourselves a question: what are our preferences? So actually, this is the question which we cannot, which we cannot omit in the end. So thank you very much again for sharing your thoughts and broadening our perspective. Thank you very much.
Pleasure. Thank you.
Thank you.
Thanks, Artur. My pleasure. Bye-bye.